Hey everyone, welcome back. Today, we're tackling something that sounds complex but is super relevant in the world of finance. What is a mortgage-backed security, or MBS for short? If you're curious about how everyday home loans get turned into investments, you're in the right place. Let's break this down step by step. First off, a mortgage-backed security is essentially a financial product created from a bunch of home loans. Imagine you take out a mortgage to buy a house. That's your promise to pay back the bank over time. Banks collect thousands of these mortgages, bundle them together, and sell them as securities to investors. It's like turning a pile of individual loans into a single, tradable investment package. How does this work exactly? Well, when you bundle mortgages, you create what's called a pool. This pool is then securitized, meaning it's divided into shares that investors can buy. These investors, like big funds or even regular folks, earn money from the interest and principal payments that homeowners make on their mortgages. It's a way for banks to free up capital and for investors to get a steady income stream. But wait, there are risks involved. Remember the 2008 financial crisis? That was partly due to risky MBS that weren't backed by solid loans. If homeowners default on their mortgages, investors can lose money. On the flip side, MBS provide liquidity in the housing market, making it easier for more people to get loans. Plus, they offer diversification for investors' portfolios. In summary, mortgage-backed securities are a key part of the financial system, connecting borrowers and investors. If you're thinking about investing or just want to understand the economy better, this is a great starting point. Thanks for watching. If you found this helpful, hit that like button and subscribe for more finance basics. See you next time.